Let's talk about the big picture with Mr. Joe Mazzola, joining me, head trading and derivative strategist at Charles Schwab. Joe, good afternoon, sir. Good to see you on a Friday. So what do you think? Victory this week, despite a little hiccup yesterday?
Yeah, maybe. I think that's victory for the tech sector, for sure. I mean, if you look at where the relative strength was, it was clearly on the tech side, on the backs of NVIDIA's earnings. And they held up fairly well. I think if you look at the industrials, you and Renita were just talking about Boeing, and Boeing was the biggest drag on the industrials and the Dow as a whole. So, you saw some weakness there. I will say this, though, Oliver, it's we're very close to the all-time highs, but when you dig a little bit below the surface, and this is kind of what I like to do, as we're looking at the breadth and we're looking at some of the indicators, advanced declines for the week were really interesting, I thought. Advanced declines were -3 to 1 in terms of decliners on the S&P 500. Same thing if you look at the kind of the broader NYSE stocks. It's just kind of showing you once again, it's been the topic for the last, year and a half, 2 years, that you still have a few kind of generals that are leading the way, and the rest of the soldiers is in step behind.
Yeah, the equal weight smacked this week. Russell rejected again. It seems like we keep attempting to get these moments of broadening out that fall short, the last one being right before April, when we started to turn lower.
That's right. And, if you even go a little bit further, if you look at, say, value stocks versus growth stocks, kind of trading at some of the lowest levels that we've seen in terms of that divergence between the two. So, the bid to value that's been really, trying to accumulate going back to November when you saw that nice little move up, as you were mentioning, in the Russell and particularly some of the value names where we saw some of that sector rotation, really kind of lead into the end of the year and starting at the beginning of the year. We've had fits and starts really ever since. But if you're looking for kind of that longer term trend, it's still really just kind of it concentrated within a few names. And, there's really one name at this point that's kind of leading the charge, and that's NVIDIA. And I think that the market collectively breathed a sigh of relief with those earnings, because it wasn't the earnings that mattered. It was the guidance going forward, because as we've talked about a few times, you've got about 80% earnings per share beat rate with the Q1 earnings, which is great. The difference was on the revenue side. The revenue beat rate was only around 52 to 53%. And when you looked at the performance of stocks on the day after, beating those earnings expectations, it was actually anywhere between, -1% to 0% relative to the S&P 500, meaning you weren't generating a lot of alpha holding those names relative to the S&P 500 because they weren't providing the revenue uptick and the guidance going forward that the market covets right now.
Yeah, good point. Okay, so the bench is pretty shallow. Basically, when you get beyond some of the key names from the macro side and the minutes too, the fact that we moved on a few of the data points we did, the minutes, was understandable, I guess, Joe, but it was also to me just kind of like, all right, well, what did you guys expect? I think it seemed to show again that some of the narrative was just really out of line the last couple of weeks on what the Fed's capable of or what they might do.
The last couple of weeks, how about the last couple of months? I mean, let's go back to in December when people were pricing in 5 to 6 rate cuts. I mean, Oliver and you and I've talked numerous times since then. I don't think anybody really expected that on our side. We might have been pricing in 2 to 3, maybe 4 if you saw a good amount of disinflation. But now I think if you look at the odds, it's 1, maybe 2. And the September probabilities shifted pretty dramatically from about 66%, 67% chance, so a 2/3 chance of a cut in September, to now about 50-50. And that's really just based upon two things that I saw, 2 items that I saw this week. You mentioned the minutes. I get what you're saying is that why was that surprising? I think what was surprising about the minutes was some of the conversation around, well, maybe we're just not restrictive enough. Traders heard that, and what does that mean? That means to them that not only are you higher for longer, but there might be that tail risk of a interest rate hike down the line. I doubt we'll see that, but I think traders, they jumped at that chance to kind of push interest rates up. You saw the 10-year trade back up around 4.5% before it be kind of trickling back towards the end of the week. But then that PMI data, to me, it wasn't necessarily the manufacturing that was that sent shivers down the spines of traders. It was really the services, because it's the services inflation that, boy, is keeping us. That's the sticky inflation that we're seeing. I get it, in terms of how much of that is built in the OER, the owner equivalent rents. We've been talking about that for a while, but until those come down, right, or until we, maybe at least start focusing or shifting our focus towards the PCE, which has a much less of a rent component built up into it, then you're going to see moves like this in terms of when you get that data. So, we got to keep an eye on the CPIs. We can't just push those aside and say, hey, we move past that. For every good print, we start to get a bad print, and we're just kind of chopping around in this higher for longer environment.
Couldn't agree more. Well said. It's funny the way the market seems to go back and forth on whether or not it's okay with higher for longer when the narrative for higher or longer doesn't change, right? It's just sometimes it's like, oh, okay, we're celebrating this, and then other times it's this is going to be a problem. Whereas the real situation hasn't changed so much. So, but I like the point about minutes to and services. A good macro take. Thank you very much, Joe Mazzola. Have a great weekend, sir.
Thank you. You too,
Trading and derivative strategist at Charles Schwab. All right, coming up.